This is a beginner's guide to the stock market explained simply. Let me start this video with a question. What is the difference between these two people? Person A has $100 in cash, but no investments. Person B has $0 in cash, but owns one share of Apple stock, which currently trades at $140 per share. Who is wealthier? Well, it depends on how you define wealth. If you ask me, Person B is wealthier because their $140 are tied up in an investment that can grow in value over time. And so far, Apple has been doing that. In the past 5 years, its share price has grown by more than 4 times. So if Person B had bought the stock 5 years ago for $35 per share, they would have made a lot of money. Hi guys, welcome back to the channel. This is the first episode in our brand new series, Investing Basics. The goal is to cover everything you need to know about investing in the stock market from scratch. Now, there are many ways to invest your money. You can put it in a savings account, or buy bonds, or real estate, or precious metals like gold, or commodities like oil. But we will focus on stocks. We will learn what stocks are, how stock prices move, and how investors make money from them. We'll also learn about different types of investments, the pros and cons of each, and how to build a good portfolio. Along the way, I will share my personal experience as a long-term investor and show you what my portfolio looks like. And hopefully by the end of this series, you'll be ready to invest your own money. Let's get started. We'll begin by answering the following questions. What is the stock market? What is a stock? Why do companies issue stocks? And how do stocks work? To answer these questions, let's look at an example. Assume that you want to open a sandwich shop. You write a business plan, find a good location, hire staff, and purchase all the necessary equipment, like refrigerators, sandwich makers, freezers, and chairs. All this costs a lot of money. You don't have that kind of money, so you borrow some from your friends and family. They become your creditors. You use the money to start the business and promise to pay it back with interest. But as time goes on, you realize that your sandwich shop is becoming very successful. You're making a profit. There are many customers and everything is going according to plan. So you think that now would be a good time to bring on other people who want to make money from your success. You do this by selling shares of ownership in your company. These are called stocks. Each share represents a small piece of ownership in your company. When you sell the shares, the people buying them become shareholders, partners in your business. In return, you give them a portion of the profits as a thank you for letting you borrow their money. If you run your sandwich shop successfully, you will generate enough money to give out both the profit to the shareholders and keep a portion of the money to reinvest in the business. If you expand your business and make even more money, the value of each share will increase. Now, if one day you decide to sell your business, the buyers will probably pay more money for it since it's more profitable than before. This means that your shares are now worth more than when you first sold them. In summary, the stock market is a place where people go to buy and sell these tiny pieces of ownership in publicly traded companies. It's a marketplace where buyers and sellers come together to trade stocks. As for why companies issue stocks, the answer is simple. They want to raise money without having to pay it back. When you borrow money, whether from a bank or from your shareholders, you must pay it back with interest. If you don't have sufficient revenue to pay back the debt, then you could go bankrupt. That's why companies like to issue stocks rather than borrow money. Now, here's a question. What determines the price of a stock? Think about it. Let's say our sandwich shop makes $1 million in profit. If the shop is doing well, people will want to buy the stock. If not, they will sell it. If more people want to buy the stock than sell it, its price will increase until a balance is reached between supply and demand. This applies to any company whose shares are publicly traded. Therefore, a stock's price is determined by the forces of supply and demand. In addition to supply and demand, a stock's price is affected by several factors. First is a company's profitability. If a company earns more profit, its stock price tends to go up. Second is the growth rate of a company. If a company's sales and profits are growing fast, then its stock price will tend to reflect that. Third is inflation. During high inflationary periods, the cost of running a business goes up. If a company's profits cannot keep up with inflation, its stock price may go down. Fourth is interest rates. When interest rates rise, it becomes more expensive to borrow money. If a company needs to borrow money to fund its operations, its stock price may fall. Fifth is a company's management. If a company has a bad management team, its stock price may fall. Similarly, if the management team is strong, its stock price may rise. Sixth is investor sentiment. Sometimes people buy stocks simply because they believe that the stock price will go up. If enough people believe that, then it will. There are two ways to make money in the stock market. The first way is to buy shares in companies that pay dividends. Most profitable companies will distribute some of their earnings to shareholders in the form of dividends. Usually dividends are paid quarterly. For example, let's say you buy 1 share of Coca-Cola stock. If the stock pays a dividend of 3%, you will receive 9 cents every year for doing nothing. However, the amount of dividend that a company pays is not fixed. It will change depending on the company's profits. The second way to make money in the stock market is through capital gains. Remember how we said earlier that the price of a stock is determined by supply and demand. Well, if you buy a stock and its price goes up, you can sell your shares and make a profit. Here is an example. Assume that you bought 1 share of Apple stock at $140. Then 1 year later, the stock price went up to $180. At this point, you have 2 options. You can either continue holding the stock or sell it for $180. If you sell it, you will make a profit of $40 minus any fees that you incur when buying and selling the stock. Capital gains are great, but they are not guaranteed. There is always a chance that when you buy a stock, its price will go down instead of up. In summary, when you invest in the stock market, you are betting on future growth. Companies that grow faster than the market usually outperform the market. For example, Amazon was once a small online bookstore that grew into one of the largest companies in the world. Investors who bought Amazon stock early made a fortune. Similarly, Tesla was once a small electric car maker that grew into a multi-billion-dollar company. Early investors made huge returns. It's important to remember that the stock market is risky. Stock prices go up and down all the time. Don't let short-term volatility affect your long-term goals. If you invest for the long term, you will be able to ride out any short-term bumps along the road. That's it for this video. I hope you enjoyed it. If you did, please hit the like button. And let me know in the comments what stock you would buy if you had $100. Thanks for watching. Until next time.